In the United States, your credit score can determine whether you qualify for a home, how much you pay for a car, and even how expensive your insurance becomes. Yet millions of Americans believe credit advice that is completely wrong. In fact, financial experts estimate that bad credit myths can cost the average person tens of thousands of dollars in higher interest rates over their lifetime. And the worst part, many of these myths are repeated so often, people assume they must be true. But what if some of the most common credit rules you've heard are actually hurting your credit score instead of helping it? Today, we're breaking down 8 credit score myths that are secretly damaging your financial future. Your credit score is essentially a risk rating created by lenders. It helps banks predict how likely someone is to repay borrowed money. The higher your score, the lower your interest rates, which means a good credit score can save you thousands or even hundreds of thousands over a lifetime. But many people unknowingly follow credit habits that sound responsible, but actually lower their score. Let's break down the 8 most common credit myths and what actually helps your credit profile. First up is a big one: the myth that checking your credit score lowers it. Many people avoid checking their score because they're afraid it will cause damage. But this confusion comes from misunderstanding the difference between hard inquiries and soft inquiries. A soft inquiry, like checking your own credit score through a free service or your credit card company, does not affect your credit score at all. You can check it every single day if you want. Hard inquiries happen when lenders check your credit before approving you for things like mortgages, car loans, or new credit card applications. Those can cause a small, temporary dip in your score. Checking your own credit is actually a smart financial habit because it helps you catch errors or potential fraud early. Avoiding it only makes it harder to stay informed about your financial health. Next is myth number 2. Carrying a balance improves your credit. This is one of the most expensive myths in personal finance. The belief that you should carry a balance on your credit card from month to build credit is just not true. Credit card companies report whether you use your credit and whether you make your payments on time, not whether you carry debt and pay them interest. Carrying a balance simply means you're paying interest unnecessarily, sometimes at rates over 20%. The smarter approach is to use your credit card regularly for your normal purchases. Keep your balances low relative to your limit, and then pay the full statement balance every single month. This builds credit history without costing you a single cent in interest. Myth number 3. Closing old credit cards improves your credit. It might seem logical that closing unused credit cards would clean up your credit profile. But in many cases, the opposite happens. Your credit score considers 2 major factors: the length of your credit history and your available credit limit. Closing older cards can hurt both of these, can shorten the average age of your accounts, which makes your credit history look less established. It also reduces your total available credit, which can increase your credit utilization ratio. That's the percentage of your available credit that you're reusing. Both of these changes can lower your score. Many financial experts actually recommend keeping older accounts open, especially if they have no annual fee. Just use them once or twice a year to keep them active. Let's talk about myth number 4. Your income determines your credit score. This is a common misconception. Your credit score is not based on how much money you make. Someone earning $40,000 a year could easily have a higher credit score than someone earning $200,000. Why? Because credit scores measure how you manage debt, not how much you earn. The scoring formula looks at your payment history, your credit utilization, the length of your credit history, and the types of credit accounts you have. While your income is very important for getting approved for a loan, it's not a direct factor in the credit scoring formula itself. This means that good credit habits matter far more than your income level when it comes to your score. Here's something surprising. Someone with a 720 credit score might pay over $60,000 more in interest on a typical mortgage than someone with a 780 score. And often, the difference between those scores comes down to small habits and misunderstandings that most people don't realize affect their credit. Let's look at the next 4 myths that could be holding you back. This brings us to myth number 5. You should avoid using your credit cards altogether. Some people believe that the best way to protect their credit is to just not use credit cards at all. But credit scoring models actually reward responsible credit usage. If you never use credit, lenders have very little data to evaluate your reliability as a borrower. An inactive credit file isn't necessarily a good one. A much better approach is to use your credit occasionally for small, planned purchases, while always keeping your balance below 30% of your credit limit. For an even better score, keeping your balance under 10% is ideal. This shows lenders you can handle credit responsibly without relying on it too heavily. Now for myth number 6. All debt is bad for your credit. Not all debt is viewed the same way by credit scoring models. The credit system often differentiates between revolving debt, like credit cards, and installment debt, like mortgages and car loans. Having a healthy mix of different credit types can actually improve your credit profile over time. This shows lenders that you can manage different kinds of financial responsibilities, from a long-term mortgage to a short-term credit card bill. Having only one type of credit might limit your score's potential. So, while you never want to take on debt you don't need, having a mix of managed debt is often better for your score than having none at all. Myth number 7. Paying off a loan will instantly boost your score. Paying off a big loan, like a car loan or a student loan, is a huge financial accomplishment. It's definitely responsible, but it doesn't always cause an immediate jump in your credit score. In some cases, your score might stay the same, or even dip slightly for a short time. This happens because closing a loan account can change your credit mix, or the average age of your accounts. Again, this is temporary. Over time, a history of responsible credit management and paying off loans will absolutely improve your credit profile. But it's important to remember that credit scores respond to long-term patterns, not just single actions. And finally, myth number 8. Your credit score is permanent. Many people with a low score feel trapped, as if it's a permanent black mark on their financial record. But credit scores are not set in stone. They are constantly changing based on your recent behavior. Negative items, like late payments or collections, usually impact your score most heavily in the first 24 months. After that, their influence starts to fade. Positive habits, like consistent on-time payments, keeping low credit utilization, and maintaining a long account history, can steadily rebuild your credit over time. This means improving your credit isn't about achieving perfection overnight. It's all about consistency. Your credit score isn't just a number. It's a financial reputation that follows you through life's biggest moments: home purchases, car loans, insurance rates, and sometimes even job applications. As we've seen, many of the habits people believe improve their credit are actually based on outdated or misunderstood advice. Understanding how credit truly works allows you to make decisions that protect your financial future instead of quietly damaging it. By busting these myths, you can take control of your score and build a stronger financial foundation. If you want to learn more about the financial systems and money strategies that most people never learn about, subscribe to the channel. We break down personal finance, credit investing, and wealth-building strategies so you can avoid the financial blind spots that quietly cost people thousands over time. Thanks for watching.